Hi everyone, this is Anurag again. So today, I'm going to continue discussing about option trading. Last time we spoke about, mostly about, the what is option trading, how it's different from traditional stock trading, and we discussed about like, that it happens in a contract, and each contract is underlying 100 stocks, and the way that option trading happens is buying call or buying put, or selling call or selling put. And today we're going to discuss that what are the different scenarios where you make money or lose money. What is the difference between buying call or selling call, and buying put versus selling put, and what at what time you will do these transactions, and showing some calculations also along the way, that which situation you make profit and which situation you might lose money, how to choose the right call, strike price or expiry date, and based on what is kind of your agenda, your objective, to make money, to generate income, or holding stock for a long time, but in along the way you make some money. So that those are the things we'll be discussing today. So let me quickly get started with that, right? So let me share my screen, and I'll show you some of my calculations and documentation that I'm doing. For me, I'm not going to, I'm not selling anything. I don't have any purpose, right? Promoting any company or any brokerage platform or anything like that. I myself use Fidelity a lot, because that's how I got started several years before. But there is no selling, and I will not ever ask any kind of personal email IDs or anything like that. I'm not selling any book. I'm not doing an advertise. I learning myself, and this video is kind of like sharing my learning, and kind of like self teaching myself also, like for example, whether I learned correctly or not by talking through these videos, is sometimes I can figure out like, wow, that's something that I need to double down, I need to learn more, or I can see something that I need to do little extra digging and all that. So let's get started, right? So we talk about call put. So call is like a bullish strategy, where you say, what, I'm going to buy a call of Apple stock, right? So I'm going to buy one contract of Apple stock at a call with the strike price of, let's say, in this case I'm showing an example. Let's say I want to buy Apple stock of $125, right? So you want to say that I'm going to pay $125 for each stock for 100 stocks of Apple. So I'm buying a call. So when you are buying a call, you are thinking that the Apple stock will go up, right? It go up whatever price right now, below 105, above 105, 125, but it is going to go up, right? So you are paying 125 for each stock. You are taking a bet that Apple stock will go much above 125, and you are buying that 125. So, or you are actually not buying that, you are actually getting a right to buy each stock of Apple at 125. So that you have this right, you are actually paying a premium. So this is will be debited from your account. You are paying a premium like a $5 for each stock. So we know that one contract equal to 100 stocks, so you're going to pay $500 from your account just to buy the right to buy Apple stock at $125, right? So this is called strike price, and this is the premium that you are paying. So your account will be debited. You have a right to purchase 100 stocks of Apple at $125 each. So you are buying that, right? Now let's see couple of scenarios. Like couple of scenarios could happen, like let's say you are buying this for a month of expiry, right? So from day you purchase the stock, it will be like in 1 month it will expire. So you will lose that right if you don't do anything. If you don't execute on that, and Apple stock, let's say, remain below 125, so you're not going to purchase at 125, even though you have the right, because you can always purchase from the market less than 125, right? So you're not going to do that. But let's say at the expiry, the Apple stock really go up. So your analysis was right. You know that Apple stock was going to go up, and it did go up, and it's 135. So now you see that the difference of what you can buy that stock 125. So you will definitely execute now at this moment. You say, what, I'm going to buy Apple stock about 125, or at 125, and because it's now $135, so I'm not going to buy from the market. I'm going to execute my right, and I would get 100 stocks at 125. So he's going to pay 12,500, right? So but the market price is around now 135, and then you can immediately sell that stock. So you make par stock 135 minus 125, $10 profit. So $10 profit on each stock going to give you 10 into hundreds, like $1,000 dollar profit. But guess what? You paid $500 premium from your pocket when you were buying the right to buy stock at 125. So that would be a debit. So it's a minus from your total profit. So $1,000 is not you're going to be you're in a total profit. Your total profit is going to be $1,000 minus 500, right? So you're going to make $500, right? So by just because Apple stock went up, you made this $500 profit. Now let's say this in this case you could have think that what if that I would have straight buy 125 stock 125 100 stocks, right? So in that case you would have paid $12,500, right? So $12,500 you had to have with you to make 100 stocks of Apple, right? Instead of that, you are actually paying only $500 premium. You are not paying anything else, but you have the right to buy Apple stock at $125 per stock, right? So you're not getting, you are not have to have $12,500. Your $12,500 is not going to get stock. You are only paying $500, and that's all. But it is giving you right to buy this stock. Now, stock could go up, could go down. For in this case, stock did go up, and now you are making the purchase. You are paying the premium, and you are making the profit. It could have gone low, and then you would have, if you would have bought this here straight up stock, 100 stocks, 12,500, stock price goes down, and you would have lost the money if you have to sell the stock, right? So let's look at the loss case situations, right? So you had a 125 strike price, and then what happened is that stock went to $115. So the $10 down from the call order that you executed, right? So now in this case, you will not be executing the stock, right? You will not be executing your contract, because you can obviously buy from the market $115. Why would you execute that? That you have to purchase the higher price. So in this case, your premium will be gone after the expiry, right? After expiry, stock still remains below 125. Let's say in this case, $115. You're not going to execute on the contract. You paid $500 premium, so $500 premium will be lost, and that is the only money you'll be losing. So your loss will be $500. But what would happen is that if you would have made the whole purchase of $12,500 here, right? Now the $10 stock is down, and let's say in a month you have to sell that stock, or you need money, or you have to just any reason you have to sell the stock, you would have lost $10 for each stock. 100 stocks is $1,000, right? So you would have lost $1,000 instead of $500. So that's kind of like giving some kind of risk management. So option trading is also about taking risk and managing that risk. So you are making a bet that stock will go up and you'll make money. Instead, stock went down, but you didn't lose the whole amount if you would have bought the whole the 100 stocks of Apple straight away, right? So those are the things that you have to keep in mind, right? In the case of like a sell a call, which is we've got shown the example where you are buying a call, but it could happen that you are selling a call. In that case, or let me go to the put section. So let's say you, instead of buying a call, you are buying a put. So buying a put is kind of like a buying insurance, right? So you have the stock already, or you want to say, I'm going to sell the stock at the price that is higher, and stock can go down. So you are actually betting on the market, that market will go down, the Apple stock will go down. So you want to say that I'm going to buy a right to sell each stock of Apple at $125, and for that I'm paying a premium to someone, right? So the someone on the other side is buying this put from you, saying that yes, I'm going to buy Apple stock no matter price goes down or not. It's I'm going to buy at $125, but the really stock went down, right? So before at expiry or before expiry, stock $115, but you get to sell the stock at 125, which is the strike price that you bought the put. You bought the put, right? So you are making, if you would have hold the stock and not doing anything on option, and you didn't buy the option or anything, you would have lost that $1,000. But you are not losing that, because you could sell that stock at 125. So basically, even though you are paying $500, you are making $1,000 profit because you're selling more $10 each stock more than the market price. Market price went down 115, and you are making the profit of $1,000 minus your premium you paid, which is $500. So 1,000 minus 500 is $500 your profit, right? So in this case, the difference between buying a call or buying a put is that buying a call, you are thinking market will go up. You are buying at the lower price, you can sell at the higher price, right? And for that, you are paying a premium. In case of buying a put, you have a bearish outlook of the market. So you are saying, the stock price will go down, Apple stock will go down. I'm going to get an insurance on selling that at a higher price I want, which is 125, which is strike price. And if stock price go down any price below 125, you are going to still sell the stock at 125 and make money by just the difference of what the current price right now, the lowest price that's possible, and the price that you have the right to sell, right? So right to sell versus here is the right to buy. So you are making the money minus the premium, right? Sell a call is kind of like, I wrote that in a bearish, but it's like it's not right. It's actually, sell a call is like, I would say that, slightly bullish strategy. Why I'm saying that, because in this case you have the stock already. So I'm talking about in a covered sell, covered call. Covered call is that you have a stock and your sell is covered. So you are not doing a naked call. Naked call is like where you don't have a stock but you want to sell the stock. With brokerage platform will make you buy the stock before you can execute on the contract. But that is a naked call, and I don't do that because that's risky. You don't have the stock, but you are saying that stock price will go up and I'll make money and I will buy later. But that's not that's a little more risky strategy. So sell a call, which is a covered call, is kind of like things that I do, and mostly I do that, and I'll explain into the details where to generate income. And that's what last several months I'm doing that, and I'm seeing that a lot of benefit in doing that, right? If you do that right. So in a sell a call, what you do is like, you have 100 stocks of Apple, and you are telling that I'll sell that stock at higher price. So let's say the stock price right now is $100, or you purchase the stock at $100. So your cost basis for each stock of Apple is $100. So basically you paid $10,000 for buying 100 stocks, right? And what will happen is that you say that I'm going to sell this call, so I'm going to write a contract where I'm obliged to sell the Apple stock at $110. For that, I'm also getting a premium. So in this case, I'm getting a premium. I'm selling it, so I'm making some money right up front. And let's say it's a premium is $5 per stock, so you are making $500 immediately by writing a contract that says I will sell Apple stock at $110. So what that means is that you are getting $500. That's immediate, income to you. And let's say before expiry, the stock remains below 110, right? It could be 90, it could be 105, 109, 102, whatever value the stock is, but it's below 110. Nobody's going to execute on that contract that they purchased from you, because they can go on the market and buy the stock below 110. Why they will buy from you at $110 each stock? So they're not going to buy that. So this contract will expire worthless, right? It's not going to be executed, and you get to keep that $500 premium, right? So what happened here? You had 100 stocks of Apple, you purchased $100 each stock, you paid $10,000 for that, and in the market you wrote a contract that says I'm going to sell a covered call on Apple with the expiry date such and such, a month, 2 month, 3 month, those things, it's kind of like a little bit of scientific analysis that you have to do. I mean, not scientific analysis, but just you have to do some math how to choose the right strike price and expiry date. But let's say you want to sell that stock at 110 and you don't mind selling that stock 110. So one thing you have to keep in mind that when you're selling a covered call, you can always get assigned between the date you went to the contract and the expiry date. You can immediately, any time between that period, you can get like assigned, which means that you have to sell the stock. So let's say in other case that stock price really went like $120, right? $120 means that person who bought the contract from you now can execute that contract and get the stock from you $110, because he's not going to buy from the market, which is $120. He's going to buy from you and sell in the market, right? The way that buy call was like, another person is buying the call when you are selling the call, right? So you are now on the other side of the table. So you see that, what happens is that your 100 stock will be sold at $110 each. So you make $1,000 there, plus you made $500. So your profit will be, your profit will be $1,500. So 500 upfront premium payment that you will be receiving, as well as you are selling that $10 more between your strike price and your purchase price, which is cost basis. So you are making an $1,000 there also by selling that stock at 110, which you purchase for 100. So 110 minus 100 is 10, 10 into 100 is 1,000, 1,000 plus 500 premium that you received is you made $1,500 profit, right? Similarly, if you see that, selling a put, the selling a put is like, you want to purchase the stock, or you want to make an income by saying that you want to make purchase of the stock. So basically you are saying, okay, the current price of Apple stock is 110, but you know what, I'm going to buy 100 stocks of Apple at $100. Just by you are obligating yourself, you're getting into the contract saying that yes, you're going to purchase the Apple stock lower than the current market price, which I don't know why some people will want to buy Apple stock more than the current price, right? So lower than the current price, $100 each. And for that obligations, I'm going to get a premium. So let's say $5 a premium you're going to get. So you made $500 immediately writing that contract. So you are selling a put right now, right? So you think that, if the Apple stock continue to go rise, it never go to $100, you never have to buy the stock. So basically what will happen that if the stock remains above $100, you're going to get the premium. The contract will expire worthless, and you never have to buy the stock, right? In case the stock is reaching 100 or below 100, then you have to buy the stock at $100 within the expiry date. And what will happen is that you are going to get assigned, and you have to have money to buy 100 stocks of Apple at $100 each. So you have to have a $10,000, right? So those are like cash secured put. Means your brokerage firm will check that you have enough money before you sell a put, before you can actually execute this contract. Because another thing that can be done is non-cash secured put, which is you can probably get that kind of thing from some brokerage platform, but I don't recommend that. And it's another thing that this kind of risky. You don't have a cash, but you are getting into contract. So I believe in covered calls, where you have 100 stocks and you want to sell and make money. Write a contract for a covered call and you are making money, or you have money $10,000 for 100 stocks of Apple at $100 each, and then you are selling put that is saying, what, if stock goes $100 below, I'm going to purchase this stock and I'm going to make an income on that, right? So cash secured put and covered calls, I think those are the two things that I'm doing. So if you like a stock that you want to make a purchase, right? Let's say you want to purchase Meta stock. You don't mind having another Meta stock, 100 of Meta stocks, right? So instead of directly go and just purchase that stock, you say, you know what, I'm going to wait for price to fall down. So you have some price in mind. So let's say the Apple, so Meta stock is currently like, $272 per stock. You say, no, I'm going to purchase when Meta will reach 250. And then I can make 100 stocks purchase, right? So you have 25,000 somewhere sitting there. Instead of waiting that, you can sell a put. Say, you know what, I'm going to buy 100 Meta stock at $250, $250. You sell a put and you get income on that. And you get some premium, like whatever premium value for that expiry date. You can say, you know what, I'm going to wait 1 month to get to the $250. And if the Meta stock remains above $250, you don't have to purchase. The contract will worthless. But if it reaches 250 and below, you can get assigned and you then make the purchase. Now, the good thing is that you would have purchased anyway, right? If you would have raised $250, you paid to $25,000, you got 100 Meta stocks. Instead of here, you are buying same Meta stocks, paying to 25,000, but you also making some payment. So you total out of pocket going down, and your cost basis of now having Meta stocks is going down, right? So let's say you get $5 for each, the premium is $5, right? So $250 of each stock price minus $5 is $245. So instead of out of pocket 25,000, you have like 24,500, and instead of 250 as a cost basis for Meta, which now you'll be looking at, price increase and sell or make profit. your cost base is gone down to $245 right now, right? So you're reducing your cost basis, or you are making $500, whatever way you want to see this, right? So this is how things works in kind of like, buying calls, buying put, and selling call, and selling put, right? Sure. So with that, right, of course, I mean, the critical point here is that, the choosing the right strike price, understanding the market trend, whether it's going to go up or going to go down, that kind of you are making a bet saying that, okay, stock price may go up, so I'll sell a call. Stock price may go down, I sell a put, or buy a put and buy a call. That's where you are using your understanding of the market, understanding of the stock that you are purchasing, at the same time choosing the right expiry date, right? So if you have longer expiry date, and you will see that the premium might go up, might go down. And if you choose the different strike price, you'll see the premium is different. So your math is going to change based on how you choosing the expiry date and premium, right? So longer the expiry date, more chance stock will follow in line with the direction that you are thinking. It could be 1 week to like several weeks, several months of the expiry date from the date of contract purchase or sale. So you have to choose. So typically, what I've seen people doing 3 weeks, 4 weeks, 6 weeks, maybe between 1 week to 6 weeks is pretty normal. But it depends on the market, depends on how volatile the market is. Typically, sometime if the highest volatile market, sometime 1 week is like lots of ups and downs can happen, and you will see that price swings very fast on either directions. Sometime in a non-volatile market, it's not that much, but also at the same time depends on which stock you are purchasing. Like, take a high growth stock, aggressive growth stocks, like most of the tech stock, like top Apple, Google, any other Shopify, or Mercado Libre, and all those stocks are very high volatile stocks, right? They swings very fast. But on the other side, like some of the stocks like Bank of America, or like Campbell Soup, and all those companies, they are not that much volatile in the market conditions. So it depends. But those are the critical areas of continuously doing research and finding out, like, how do you choose best strike price and best expiry date, right? Those are the kind of like science that we need to be very cognizant of, to know when to do what thing, right? So these are kind of like basic principles of buying, selling, call, and put. But then all of these things also can be combined to make some transactions that are really kind of giving you a little bit of flexibility in either direction market moves. You can still have a more chance of making money than losing money, right? So you can combine buying a call and selling a call. For example, let's say you don't have any stock and you want to sell a call. Instead of just write out buying the stock, you can buy a call of Apple at $100 and then sell a call at $10. So you have a $10 for each stock, which is $1,000 for 100 stock chance of profit. And in that case, for buying a call, you give a premium. So you pay a premium. Let's say you are paying premium of $2.50. So which is good, $250 will be out of your pocket, and selling a call going to make $1.25, right? So you make $125. So 250 minus 125, $125 will be out of your pocket then and there, right? You buy a call of one contract, you sell a call of one contract, two different strike price, same kind of expiry date. You are out of pocket $125 debited from your account. So that's the total transaction. Now let's say Apple did remain between 100 and 110. What will happen is that if it is you bought a call 100 and it went 105, so you can purchase the stock at $100. So your buy call will be worth $500 because you made $5 profit from this transaction. Your seller call will expire worthless. So $125 you paid, but now you made $500. 500 minus 125 will be like $375 you will make as a profit, right? So let's see that transaction, right? So let's go to this section where I have some of this transaction written. So sometimes that is called like a debit spread as a terminology, but basically what you are doing, you are buying to open Apple call at 185, and then you are selling a covered call at 190, right? With the expiry date, and your premium for buying the call is $3.25, which is $325 in total out of pocket. But for selling that call, you are making $1.21. So you are getting $121, right? So basically the difference of these two is for your out of pocket, right? So basically that would be your net debit $2.04 for the each stock, right? So $204 will be out of pocket then and there. Now, but what will happen is that you can sell the stock at $190, right? So 190 and your purchase price 185, because you had a call on this 185. So basically 185 minus 190 minus 185 is $500. $500 minus 204, which is out of pocket for you. You made $296 at expiry, because you could sell the stock at a higher price, 190, right? If the stock goes 190 and above, you can sell that stock at $190, and you will get the difference, $500, but you paid $204, you made $296. So that would be, kind of the debit spread is called. Why debit? Because getting into the transaction by buying a call and selling a call, you had a debit of $204 from the market. Now, if the stock goes down, below 185, then no point of you not going to buy the stock for $185, right? So you are going to lose that money, but you're going to lose that money is that the only money that you're going to lose is $204. So premium. So nothing happens. You don't get to buy the stock, don't get to sell the stock, but $4 premium that you paid will be lost. So your max loss is capped, and your max profit is also capped, right? So the stock can go like $200, $300, whatever. You don't get more than $296, because you will be get assigned at $190, right? Similarly, another example of Palo Alto Network, same thing, that you buy a call at 230, you pay premium $3.25, sell a call at 240, and you get $125. So your net debit is $2. Basically, that would be like $200 out of pocket. And then the stock price, if you go above 240 minus 230, 10 into 100 is $1,000 minus $200 premium that you paid, debit from your account, it's $800 that back profit you pay. Now look at the situations here, right? So here, to make $296, you are kind of like taking a risk of $204 loss, right? So you either make $296 profit, or you make $204 loss. Now look at this, almost like 100% profit loss ratio, right? So you are taking like 1:1 ratio, right? So your loss and profit is basically similar. That's for many people is not a good strategy, because you are really go either way and you make the same money or lose the same money. Here is on the other hand, for $200 loss risk that you are taking, you are betting on $800 profit. That's 1:4 ratio. So that's a good strategy, because you are taking a less risk, but you for a bigger profit potentials, right? So for some people, this will be good strategy to get into. So that's why I'm saying that this could be any ticker doesn't matter. This could be any company, doesn't really, for this purpose is not important. The important thing is that what strike price you are choosing, which direction the stock is going. Is it going to go up? If it's going to go up, it's good for you, because then you can sell at 240 and you can make this money. And you always do this calculation to see that, what is the, risk versus reward ratio that you have, right? And that's key for, choosing which call that you will open, which call you will close, and how you will take the risk, right? So often, like you can make up your mind. You can say, what, I will take 1:3, 1:2, or 1:4, or some people 1:10. Like they want to say, I can lose $200, but I have to have a potential of making $2,000 profit, right? So it's up to you. That is what the risk management is about, like how much risk you are taking for what kind of reward. But definitely you should look for, the whole point is that making more reward than loss, risk of loss. So those are the important aspects for me. At least I've seen that I choose this carefully, do this calculation first, and see what is my risk and reward ratio, and then then I choose whether I want to execute on the trade or not. At least that's how I have been doing, and so far not doing bad. But I would say that this is not that simple. There's a lot of other considerations like market volatility. Suddenly you think that the direction is this, but then direction can change because of some market event, a company event, or economical event, or macro and micro can change. So all of those things can feed you every single day to look at how things are moving. So with that, I'll close the discussion today, and definitely next time I'm going to get into more of those volatility I talking about, how to measure those volatility, what volatility is good for you for selling call and buying call. So there are a lot of technicalities involved, and those are called option Greeks. This is nothing to do with Greece, but it's like a Greek symbols, which is like a mathematical symbols that are assigned, and those are underlying difficult mathematical calculation is there, but we don't have to get into that. We will understand what are those Greeks are, like delta, theta, and gamma, and how those impacts, and what kind of high level, what are kind of thumb rule that we should follow, what delta value we should choose when we are selling stock, and how that relates to chance of making profit versus chance of losing that, right? So when you are selling stock, you want to stock value remain below your strike price, so that you don't get assigned, and you also get the premium, and then you can sell the call again, right? So your intention would be like, okay, making income from the stock that you already own by continuously selling calls. By selling put is a similar thing. You want to maybe eventually you want to purchase the stock, but while attempting to purchase the stock, you want to create income. So you want to have the stock value above the strike price in case of selling a put. So delta will kind of like give some kind of indications, although that delta just change. But I'm going to get into a little more technicality and details on to how to find good delta, good theta values, and all that. Theta is like a time decay that determines like how your premium is going to get impacted as you approach the expiry date, right? So theta for selling a call, which I do most often, is on the side of the seller, because as theta approaches to the expiry date, the chance of making that premium, making the income increases faster, right? So this has a like acceleration rate. So we'll get into those details on a high level, I would say. We don't have to really get into too much into that, because there is thumb rules that we will follow, there is kind of boundary that we'll get into, and we'll make sure that we have good understanding how to use those in our benefit, right? So with that, thank you very much, everyone. And again, I'm not selling anything, just for educational purpose. I'm not a financial expert. I don't recommend it to do this or that, buying stock, selling stock, but all is that how these things are done, what I'm doing, and what I'm learning also at the same time, right? So thank you very much. Bye bye.